This has just gone vertical. Nobody goes broke taking profits. The more extreme the hockey stick, the more likely it is to roll over, right? And people say, oh, he's got no conviction. Oh, he's selling to. Taking profits doesn't mean exiting the market. It just means locking in your gain. And gold's still holding in there. That is extremely bullish in my view. And it did it at 2,000. It did it at 3,000. If 4,000 is the new 3,000, that implies like 5 to 6K being the next leg up.
In a recent market discussion, seasoned investor and precious metals analyst Lobo Tiggre breaks down the explosive move in gold's price and what it signals for the next phase of the market. As prices have gone nearly vertical, he cautions that while momentum is powerful, parabolic charts rarely last forever. A sharp rise, the hockey stick formation, often precedes a correction, but that doesn't mean the long-term trend is broken. He reminds investors that nobody goes broke taking profits. Locking in gains isn't about abandoning the trade, it's about managing risk and staying smart in volatile markets. The current behavior of gold, even while consolidating at record highs, shows immense strength. Each time the market has paused, whether around $2,000, $3,000, or now $4,000, it has built a higher base for the next surge. If $4,000 truly becomes the new $3,000, it sets the stage for a potential move toward $5,000, $6,000 per ounce in the coming rally. With physical demand strong and macroeconomic uncertainty persisting, gold's long-term trajectory appears firmly upward. If you found this analysis insightful, don't forget to like, share, subscribe, and comment below. Your support keeps these deep dive market breakdowns coming.
When that silver squeeze was happening, the physical squeeze, and silver goes screaming up to $54 an ounce, long-suffering silver bulls are celebrating, but I'm like thinking, wait a minute. When silver starts catching up to gold, even your most diehard silver bull will tell you silver lags at first and then catches up or more than at the end of the bull market. So if this is that catch-up phase, that means it's the end of the bull market. And I don't think so. I'm a fundamentalist, not a technical, but even with gold over 4,000, I look at the world, the central bank buying, the money printing, the inflationary agenda in the United States and Europe, even China promising, almost like Mario Draghi, I'll print all I have to get inflation going again, right? All of this is extremely bullish for monetary metals, other metals too, just commodities, anything real actually in this world. So I'm remain bullish on silver. But that temporary surge on the basis of this London squeeze, I'm glad to see it resolved. I'm glad to see silver consolidate in the 40s, not 30s. Right. That's a profitable price for these companies and for the better projects out there. There's nothing wrong with $40 silver in terms of the business of mining this stuff right now. People say, oh, he's selling gold. No, I'm not selling gold. It's my bullion stays there unless I absolutely need it for one way or the other. But as a speculator, it's my job to make money in the stock market and to realize those gains, right? So I think it's extremely bullish what we're talking about. If we're consolidating and forming a new floor before the next move up, that's great. All the fundamentals, I think, support that, like the central bank buying. We've talked about this before. I don't need to wax rhapsodic about that. But that is the most important thing to me, is that that's a one-way door. That doesn't change. Trump and Xi kissing and making up doesn't mean suddenly China's going to be happy to have its financial lifeblood flowing through New York, right? So that actually limits the downside in my view. I don't think we can count on central banks to chase the price higher, but they do buy the dips. I think we have seen this over the last couple of years, and that's really interesting. So I don't want to give you too much clickbaity headline there, but believe it or not, I'm feeling much, much better about both monetary metals right now than a month ago when it was doing this. When it was doing that, 10 years ago, we would have been ecstatic to be talking about $4,000 gold, $5,000 gold, right? That we would think that would be it. Like we would be arriving at the blow off top. And now that we can be at this level and think of it as just another shoulder before the eventual head, I think that's extremely positive. The point is we just saw a hockey stick, and we saw a hockey stick on top of a hockey stick. And so, to say this is it, it's going to the moon, it could be, but that's a big ask. And so what I'm saying, the reason why I'm stressing this is because there was a not just a non-zero or a non-trivial, but I think there was a significant chance that, gold goes zooming up, it hits some kind of fulfillment number that Mr. Market has in his head, and he just decides to sell, and that trigger stops. There's a cascading event. So hitting almost 4,400 could have been the thing that sent it back down to 3,400, which would be a great actual level for making money in the business, by the way, but the stocks obviously would tank if that happened. So given that the alternative to what you've just said, Craig, is this massive retreat, too far, too fast, it would be anything but surprising to see a much more substantial correction. So actually, this is maybe the most optimistic, bullish thing I can say, this whole conversation, is that the fact that gold is wobbling around 4,000, I think that's fantastic news. Because the alternative is, went up and then boom, like really boom, way back down. And that doesn't seem to be happening now, even though, there's been headwinds, the peace with Gaza or peace with China in the trade war, whatever, and gold's still holding in there. If you're a central bank and you've been told by the, your powers that be, your marching orders are, we don't trust the dollar, we need to diversify, you need to start accumulating gold. What are you going to do? You're going to chase the highs? Of course not. I mean, my mentor, Doug Casey, has had unkind things to say about the intelligence of the average central banker. But their minions who are in charge of implementing the policy, of course, they're going to be buying on the dips. So I just see this as really important. And if you want to make a case that this time is different, famous last words, blah, blah, blah. But this actually is different. If you and I have enough silver in our hair to remember the central bank gold selling agreement, remember, we're not going to sell more than 500 tons a year, blah, blah, blah. Like, the concern before was the central bank selling. Oh, so yeah, that is kind of different if we're in buying mode. But one thing I will say, dear gold bulls out there and silver, but the central banks aren't really accumulating silver. I mean, which of us is not suspicious of the motives and the trustworthiness of central banks? The mines that are in operation now, they were designed at like $15 silver or less. It's not so long ago that, especially the long in the tooth mines. So they have to be either printing cash, and if gold and silver are real money, right? Like almost literally, like they have to be either printing cash or they're doing something very wrong. And on the making money side, like this is actually the market giving you a gift. If you're a speculator in the stocks, there's a temptation to say, oh, they've all run up. What's still on sale? What's cheap? Well, if something is really cheap, or if the company is not delivering in this environment, that's not a bargain. That's not a deal. This is when we just climbed a hockey stick, that's not the time for bottom fishing. If the entire market is telling you there's something wrong with this company and you don't see it, I mean, have a little humility here and maybe consider that maybe there's something wrong with that company.
In this insightful segment, market analyst Lobo Tiggre reflects on the recent surge in silver prices during the physical squeeze that sent the metal soaring past $50 an ounce. While many investors viewed it as the long-awaited catch-up to gold, he sees the move as part of a broader, ongoing bull cycle, not the end of one. The fundamentals, he explains, remain overwhelmingly bullish for both gold and silver, backed by relentless central bank buying, global money printing, and mounting inflationary pressures. He argues that the world's major economies, from the US to China, are all pushing for inflation, which only strengthens the case for monetary metals and real assets, even with gold consolidating around $4,000 and silver holding firm in the $40 range. The structural support beneath these markets is stronger than ever. According to him, this period of consolidation is a healthy pause, not a reversal. It allows for the establishment of a higher floor before the next leg up. With central banks continuing to buy the dips and physical demand steady, he believes both metals are far from done climbing. Let's get into the interview.
If you adjust gold for CPI, we have hit a real all-time high, even including the 1980 peak. That is far from the case from silver. So if I'm bullish on monetary metals, but I'm nervous about chasing gold over 4,000, silver is a much more compelling buy. It literally needs to still, even from 50, it needs to go 4 times higher to reach a real high. And that's even just using the CPI, never mind a real inflation adjuster. So, I'm actually quite bullish on silver. And by the way, I know you mentioned it earlier, but I'm also bullish on copper. And silver, as we all know, has an industrial side as well as a monetary side. I see that actually as a win-win thing, not a bad thing. Some people hate it when I say that. Oh, silver's money. But if I'm bullish on gold and I'm bullish on copper, how can I not be bullish on silver?
Right.
I really like the uranium story. The only problem I have there in terms of making money is that it's so obvious that the stocks have actually not sold off with the volatility and the spot price. And so finding opportunities has been a bit tough. I'm waiting for another big scare, and they happen. Like just earlier this year, there was that DeepSeek scare coming out of China, and nuclear has been sort of an AI play as well as a green play, and the uranium stocks just got clobbered, like 52-week highs to 52-week lows on that news, and it was completely ridiculous. I mean, it. And many of the better ones have come on to new multi-year highs since then, just in the last few months this year. So I love it. I'm long already, so I'm not feeling any FOMO, but I'd really like to see another one, volatile opportunity like that to buy. The rare earths is much, much harder. We say rare earths, REEs, whatever, but it's not one thing. It's a whole suite of different metals,
Right.
Different mixes and different deposits, the light rare earths and the heavy rare earths and different concentrations. So there's no off-the-shelf processing technology that does this. And, there are multiple projects I can think of over the years where they've gotten as far as a full feasibility study, a bankable feasibility study, and that stuff's still sitting in the ground. The underlying prices are also subject to big volatility. Like the rare earths, anybody with rare earths from their name was seeing a lot of buzz earlier this month.
Yep.
And then suddenly there was news out of China and they all fell off a bit of a cliff. Right. And now we've got news, as you and I are recording, we've got Trump and Xi have made a deal. It's not really a deal. It's just postponing, the truce, as it were. And China's going to postpone, they say, their restrictions on the rare earths and the magnets. The details, potentially quite diabolic here. I have no idea how it's going to play, which ones, right? And is it going to apply to the processing or just the minerals themselves? Right? We just don't know. But the point is that, let's say they really open the floodgates. Well, what's going to happen to your rare earth stocks?
Right.
So this is not like, copper or even gold and silver. Like there's no sudden news that's going to suddenly tank copper, right? There's no Chernobyl meltdown that can melt down copper. There's no one mine that can open up and flood the world. But with rare earths, the prices are set by political fiat.
Yeah.
I mean, what is the solution that the Western countries are talking about? Japan, another deal with Trump. And what's their deal on rare earths? We're going to support price floors. Japan doesn't produce rare earths, right? So what can they do? Well, they can promise subsidies, basically. That's another political fiat. Who's to say the next administration here or there won't change that? Sorry, we can't afford it. So I'm not saying there's no money to be made in rare earths. And certainly in this environment where the United States government is buying stakes in critical minerals companies, we've seen that move share prices. If you can get ahead of that lightning bolt, I don't know how to do that, but if you can do that, congratulations, good luck to you. But, what the government giveth, it taketh away. And that applies to all governments. So my takeaway here is not that you can't make money in the space, but it's very difficult to do in any kind of reliable, disciplined way. I see it as much more of a gamble than the kind of rational speculation that Doug Casey and Rick Rule taught me.
In this compelling market breakdown, Lobo Tiggre shares his view on the next big plays in the metals sector. While gold has already hit real all-time highs when adjusted for inflation, silver remains dramatically undervalued. Even near $50 an ounce, it would need to quadruple just to match its historic inflation-adjusted peak, making it one of the most compelling opportunities among monetary metals. Silver's dual role as both an industrial and monetary asset adds further strength to its case, especially as global manufacturing and clean energy demand accelerate. Beyond silver, uranium stands out as another key opportunity. Despite recent volatility triggered by market overreactions, uranium fundamentals remain strong, supported by the growing recognition of nuclear energy as a green and reliable power source. However, rare earth elements present a trickier story. Highly political, volatile, and dependent on unpredictable global policy shifts, especially between the US and China. In short, precious and strategic metals are entering a defining phase where patience, timing, and discipline matter more than hype. Understanding the difference between long-term conviction and short-term chaos will separate the winners from the gamblers in this evolving market. If you found this analysis insightful, don't forget to like, share, subscribe, and comment below. Your support keeps these deep dive market breakdowns coming.